Jared Lopez, here for Next Generation Trust Services. Next Generation handles self-directed retirement plans. With me on this presentation today is Roger St. Pierre. Roger is the Senior Vice President of First Western Federal Bank. They are one of the few banks out there doing non-recourse loans to retirement plans. So if you have money in an IRA, you're looking to purchase real estate, but you do need that mortgage, you do need that loan, Roger here is your man. He will be discussing the process of getting non-recourse loans. I'm going to be doing a brief explanation on self-directed IRAs, and then we'll pass it along to Roger. If you have any questions, there are two ways that you can ask those questions. You can type them into either the questions tab or the chat tab on your dashboard. So we're going to get started. Again, I represent Next Generation Trust Services. Next Generation is a third-party administrator for self-directed retirement plans. So that term alone, just self-directed retirement plans, it can be confusing. The honest truth is that it's no different than your IRA or your retirement plan at a Charles Schwab, Fidelity, any of the bigger custodians. The only difference is we allow our clients to invest in non-traditional assets, whereas Fidelity, they allow you stocks, bonds, mutual funds, CDs. Next Generation allows you to invest in real estate, to make loans, to invest in startup companies. But with that, we're not a bank, we're not a financial planning service. You can't call me up and ask me what the best real estate market is to invest in. I can't help you there. So we're a third-party group of administrators, not financial planners, in order to help you with your self-directed retirement plans. We do the administrative work for that IRA. Again, we don't endorse or recommend or sell any products, even though we're on this presentation with First Western Federal Bank. We're not affiliated with them at in any way. If you were, another little disclaimer, I know I gave it before, but we don't review the merits of any investment. We don't endorse or recommend any products or services. So getting started, there are several types of plans that can be self-directed. If you have any type of IRA, that plan can be self-directed. That plan can be, it can invest in non-traditional assets, including real estate. So if you have a traditional IRA, which is tax-deferred, today's tax day. If you made your contribution for 2013, it is a tax write-off in 2013. However, when you're at a later date, when you do take those funds out, you will be paying taxes on that as well as any earnings. With a Roth IRA, it's not a tax write-off. You're paying taxes in the current tax year, but the beautiful thing with a Roth IRA is that the assets and any earnings that you receive from those assets are tax-free. So if I put $5,000 into a Roth IRA currently, I make a couple great investments, and down the line it's $1 million. That is 100% tax-free. The SEP IRA is for self-employed individuals. It's the same type of plan as a traditional where it's all tax-deferred, only the contribution limits are much, much higher with a self-employed plan. You can actually contribute up to $52,000 for 2014 as opposed to a traditional IRA where it's $5,500. A simple IRA is for small businesses. You can also, if you are establishing a 401k, you can actually have a portion of that 401k be self-directed. So if you do have a 401k plan, but you do want to have that portion that is invested in real estate, you can do that. If you're with a larger company, typically they do not allow self-direction. You're very limited as to what investments you can make. But once you leave that company, it can certainly be rolled over into an IRA. There are a couple of plans that are not retirement related. The first one is the Coverdell, which is for child's education, for higher education. It can be books, room and board, anything that has to do with a child's education. You can put money away to that on an annual basis, and actually that Coverdell can be self-directed. The same goes for a health savings account, and that's for medical expenses, but that is a plan that you do need to qualify for. The options for funding an account, Contribution, like I said, it's tax day. You put away money from your own personal account. That is your contribution for the year, but if it's in a traditional or a tax-deferred plan, it is a tax write-off for that tax year. You can transfer funds into your self-directed IRA account. So if you have funds with an IRA at Fidelity and you want to keep a portion of that, but you want to move a portion to Next Generation to do self-direction, that is a transfer. A rollover is from unlike plans. So if you have an old 401k and you want to roll that over into an IRA, that is indeed a rollover. A conversion is something we're seeing a lot of with just people not doing so well in terms of making money on an annual basis. People are choosing to pay taxes on their retirement plan funds in this current tax year and switching from a traditional to a Roth account. That's called a conversion. You're paying taxes in the current tax year, but then the assets and any earnings that go along with those assets from here on out are completely tax-free. So we actually had someone who had a property in their traditional IRA. They converted it to Roth. They paid taxes on that property. It was a big tax hit. However, now any of the earnings that they receive on that property, so rental income, and then when they sell the property at a later date, that's all of the earnings are tax-free. So now we're going to get into the meat of the presentation, investments. So the easiest way to get started in terms of investments are things that you can't invest in. You can't invest in life insurance, and you can't invest in collectibles. Literally anything else that is an investment, you can invest using a self-directed IRA. So you'll see collectibles on there, things like art, wine, stamps, baseball cards. You can't invest in. There are some sort of collectible coins that you cannot invest your retirement plan into. But literally anything else you can. The other thing you would have to watch out for is dealings with disqualified persons. So these people cannot have any interaction or any personal gain from the investments within your retirement plan. So what that means is if you're, we all know that you can invest in a property using your self-directed IRA. None of these people, these disqualified persons, can live in the property, can provide any contracting work to the property, can rent, even if it's renting out the property at a fair market rate, they can't do that. So if you have a property, your son, who is a descendant, cannot live in that property. Your father's contracting company cannot do the work on that property. You cannot, do any landscaping on that property. So you really have to watch out for dealings with disqualified persons, because if you are caught doing that, it will be prohibited, and it is a prohibited transaction. So we talked a little bit about the investments that you can do. As I mentioned before, anything else that you can invest in using a self-directed IRA. So real estate is the biggest one. Mortgage notes, tax liens, hedge funds have been becoming more and more popular. People are investing into startup companies or just companies in general, limited liability companies. You can invest in precious metals. You have to invest in precious metals at a spot price. You can invest in the collectible coins, like I mentioned before. People are making loans. One person invests in teak and mahogany trees in Costa Rica. It's an unbelievable investment. This person bought seeds and contracts to these trees in Costa Rica. It's a 10-year contract, so when the trees are fully grown, cut up, and sold and made into our furniture, that's when she'll get a return on her investment into her IRA. You do, again, need to remember about the disqualified persons, though. So if you had a note out, if you had a loan out, you cannot loan to yourself or anyone on that list of disqualified persons. You can't loan to your spouse. You can't loan to any ascendants or any descendants, so parents, grandparents, children, grandchildren, and their spouses. But you will notice I'll go back on the list of disqualified persons. That not on that list are brothers, sisters, aunts, uncles, cousins, nieces, nephews. All of those are not disqualified. So if your IRA has a property, your brother can live in that property at a fair market rate. Your niece can, or your niece or nephew can provide that contracting work at a fair market rate. It's just very important that you're not giving these people any deals or having them live in, just cutting any deals. They're not allowed to do that. So, but anything else that's an investment, you certainly can invest in using a self-directed IRA. How it would work in real estate: first, you'd locate the investment property. You'll set up your account with Next Generation Trust Services. Once you have that account set up here, your IRA is given its own name and its own tax ID number. So it is its own entity. That entity can go out and negotiate the purchase contract. So you will write the name Next Generation TS for the benefit of your name and your IRA number on the contract. When that contract is approved, you'll submit it to Next Generation Trust Services with the deposit instructions where we're going to send the funds. So Next Generation also executes any of the documents on behalf of your retirement plan. So you'll send all of those you'll send the contract, you'll send the deposit instructions to us, we'll sign it, and we'll send out the deposit. And at that point, you do the home inspection, the title search, everything on that property. Again, everything needs to be paid out of the IRA. So if your IRA is owning this property, that title search, that home inspection needs to be paid out of the retirement plan. It can't be paid by you personally and then asked to be reimbursed. It does need to come from the IRA itself. You'll submit the closing documents to Next Generation, and we'll fund that for you, and that is how your retirement plan will own a property. So I'm just going to leave this up here. I'm going to give out my contact information. I know this was a very, very brief presentation. We really want to get Roger on, but you can call me. My name's Jared at 888-857-8058. That's 888-857-8058. Or you can email info, that's info, at nextgenerationtrust.com. And I'm going to be taking all of the questions at the end. But right now, I want to introduce the Senior Vice President of First Western Federal Bank. That's Roger St. Pierre. How are you today, Roger?
I'm great, Jared. I really appreciate the opportunity to speak to your clients today and other listeners that may be part of the call. And I think it's a great opportunity to learn a lot about a topic that is forefront in many people's minds today, and that is buying property with your self-directed retirement plan and then financing a portion of that purchase. First Western Federal Savings is a nationwide lender. We lend in all 50 states. We, by our charter, we're a federal savings bank, can lend in all 50 states, and we do. And we are, as this disclaimer slide will tell you, we are a bank, and we are not accountants or investment advisors, and we're not qualified to provide advice on IRA rules, regs, or eligibility requirements. So do please consult with your tax and investment advisors if you have a specific investment that you want to make. Now, the meat of the conversation that I have today is on how you leverage your IRA funds and take out a non-recourse loan. And a bit on the real estate side of it, and I don't need to tell you real estate investors the beauties and benefits of investing in real estate, but I'll just outline kind of the main issues and the advantages I see now on tapping retirement funds. One, it provides a great ability to diversify your retirement plan. Granted, it's good to own some stocks, bonds, and mutuals, but that shouldn't be the entirety of your retirement plan. It ought to have some diversification into real estate and other kinds of investments. Real estate offers that diversification. In a real asset, you can touch, feel, and see it. It's a hard asset that is going to retain value in good times and bads. and it doesn't have the big fluctuations under normal markets that other kinds of paper assets do. There's a lot of choices in today's market due to the foreclosures that took place between 2008 and 2011 and are still happening in some markets. You can still find some very good deals on properties depending on what market of the country that you're buying in. Those affordable prices actually are now allowing better cash flow. And with that better cash flow, you're going to get a rate of return on your IRA from the rental income. And that's a beauty because rent, as Jared mentioned, is not taxed within an IRA until you pull the money out, never taxed in a Roth. But then you also, in addition to the monthly cash flow or annual cash flow, you do have the ability to capture that upside capital appreciation as that asset increases in value over time. So real estate does make an excellent asset, a diversification strategy for your IRA. When you're buying real estate, though, you do need to do your due diligence. And I say look under the covers. My next slide will get into some of those ideas that just because you may be getting a good price, that doesn't mean it's a good deal. And you really need to look at all the aspects of the property itself. Make sure that the structure of the building is good, that the meat and the bones are good. We as a bank have typically a date of 1940 or newer in terms of a build date that we like to lend on, simply because most of those kinds of properties are going to have less deferred maintenance than others. We can, though, however, lend on buildings that are older than 1940. We may require for example, a home inspection or a further documentation of the condition of the building besides just an appraisal. So make sure you're getting what you think you're getting. And if you're buying a condo or townhome, that condo or townhome is going to be located within an HOA, a homeowner association. There are some benefits to HOAs, but you really need to understand the workings of those and understand that that HOA is there to fund and pay for all the upkeep on the buildings, the maintenance, and the grounds of the community. So you really need to do your due diligence and look at the financials of that HOA. Don't just take it for granted that it's solvent. So I always recommend getting 2 years of financials and a current year budget. Take a look at the reserves. Do they have ample money set aside to replace roofs and air conditioners and different things for the pool and what have you over time as that condo or townhome, it does have expenses. So make sure that HOA is solvent, and don't hesitate to ask your realtor if you're buying. Don't hesitate to ask them to get those financials from the HOA because they do owe you as a buyer for those. Target. What do you want to target for your properties? Obviously, a diverse economy is going to provide better basis for your renters. Short commutes to job centers, close to your amenities, services, schools, and probably one of the bigger things is favorable rent to purchase price. You try to hit it. It's not necessarily possible in all markets, but you try to hit that 1% rule where your monthly rent is about 1% of purchase price. Also look at crime. Take a look at the crime areas of the properties that you're considering, and there is some websites out there that now offer crime statistics and crime data. And crime will have an impact on not only the tenants that you may get into your property, but how long they'll stay and the appreciation potential. So once you have picked out a property, you've made the offer in the name of your retirement plan, now it's time to leverage some of your own monies and get a non-recourse loan. And so what is a non-recourse loan? Well, a non-recourse loan simply means that the bank has no recourse against the person or any other assets in the IRA itself. And so you as a person borrowing the money through your IRA do not sign a personal guarantee. The loan does not show up on your personal credit. The retirement plan is the borrower, not you. And if you can just get that in your mind, it's very simple. It's just a regular, it's a mortgage loan, but your retirement plan is taking that loan out, not you. There's basically four main issues to the underwriting of these loans. So how do we look at these loans as a bank? Well, the four issues on the next slide that I see as the real meat of the underwriting are, one, do you have the money? Show me the money. And that's, by that I mean the 40 to 50% down. You'll find that in the non-recourse world of lending, the loan to values are more conservative than they are out there in the personal borrowing world. So 60% loan to values are pretty normal throughout the country. There are some kinds of properties in some areas that we may require a little bit more down. Commercial properties, for example, we may want more down than residential. So we want to make sure you have the money. So we will look at your account statement, and that'll tell us if that down payment money is there, if there's money for closing costs. Figure you're going to have your normal appraisal, title work, closing costs like you would on any property you purchase throughout the country. And we like to see 15% of loan amount still left in the plan after closing. Probably one of the biggest things that people don't estimate properly is the amount of maintenance and startup costs on a rental property, especially one that's never been a rental before. You may have to replace some carpets, some paint, do different things to the property to get that thing in rent-ready condition. You need to have funds to do that. We as a bank don't lend rehab monies. Those monies would need to come out of your plan. So not only do you need the money to buy it, but you should have money on the sidelines, and they can be, that money can be in your other liquid investments, but we want to see a minimum 15% of loan amount still in a liquid investment within your plan. So if you go some months without a tenant, you have operating funds. If you have a repair, as you may know, or as Jared may have just explained, you can't just reach into your hip pocket when Joe the plumber comes over and hands you a $1,000 plumbing bill for a repair. That money needs to come out of the IRA or your retirement plan, so you need to have some money set aside. So just keep that 15% figure in mind, and that should be of all IRA loans or retirement plan loans anywhere that your plan has. Cash flow, that's king. Does the property cash flow positive? As I mentioned earlier, we're not lending to the person. I don't look at your personal financial statement or tax returns. So it doesn't matter whether you have $100,000 or $200,000 laying around personally. I can't visualize, I can't use that as ability to pay the loan back. So the property itself has to pay the loan back. So we take debt service coverage of 1.25 or greater. If the property produces that for income, that's good. And then really I look at essentially probably two other components besides the money and the cash flow, and one is the property a good one, and that gets back to, is the property in good shape? Is it going to need a lot of deferred maintenance or not? If not, is a good thing. So a quality property in a good neighborhood, and lastly, does the transaction make sense? In other words, is the management component in place? Are you as the IRA owner going to manage the property, or is the property in a remote city and you're going to have a third-party management company, for example, manage it for you? We want to just make sure that you have accounted for the management aspect of it as well as the cash flow. Now, what do I mean by cash flow? And I'm going to get into that just a little bit more here on this slide about debt service coverage, because that drives the cash flow and the underwriting to pay the loan off. And so what is debt service coverage? In a nutshell, it's your net operating income divided by your loan payments. And in this example, easy to follow, a person has a $100,000 home in their IRA. They're renting it out for $1,000 a month. We would take their gross rental income, $12,000 a year. We use a 7% vacancy factor. You can't figure that the property is going to be leased all 12 months a year. 7% represents about 1 month or so that the property would be vacant. Build that into your model. Then taxes, insurance, Any maintenance, you should build in some maintenance for your property regardless. If there's HOA fees, build those in. If not, don't need them. Same with utilities. Most landlords would have their tenants paying utilities, so that's typically not an expense. Management, if you're not going to manage it yourself, you probably are going to have a third-party company out there managing it for you, collecting rents, sending them to your IRA administrator, and they're going to charge for that. So build in that management fee. So in this example, we took $12,000 in rental income for the year. We subtracted the costs, and we ended up with a net operating income of $73.60. We divided that by the principal and interest payments for a year, and I just figured up some payments on a $60,000 loan. They'd run about $3,900 for the year. You take $73.60, you divide by $3,900, and that gives you a debt service coverage of 1.89. Another way of saying that is that your net operating income is 189% of your loan payments, and that's what you want. You want to have all expenses paid and your loan payments paid and still have positive cash flow going back into your retirement plan. One aspect of the loan that you ought to be aware of, though it may not be triggered, is that there is a tax called UBIT. And what is UBIT? Probably never heard of it, but UBIT is an unrelated business income tax. And Congress put that into play back in the mid-50s when they were trying to level the playing field between tax-exempt entities that were conducting private businesses. And they said, you know, that's not really fair to the rest of the private business people of the world if your tax-exempt companies can go in and run a business and compete since they don't have to pay taxes. So Congress created this tax essentially so that tax-exempt entities would have a level playing field with other private business. But how it comes into play with the IRA or self-directed retirement plans is that this tax also does come into play because the IRS deems an IRA as a trust, and this is not necessarily a income that the trust would normally make if you're making it off the bank's money. So on my next slide, what I will tell you is that you may have to pay some tax, but it's based on your average indebtedness over the course of the year. And what that means is that if you have less debt on your property, you're going to have to pay potentially less UBIT. And on the next slide, I'll get to how that's computed. UBIT is basically a tax that comes into play if you're making money on somebody else's money. In this case, you're going to be making rental income off of the bank's loan. And if we took this example, we'd say that there was a $500,000 building and you had a $250,000 loan on it. That would mean that potentially 50% of the profit, because there's 50% of that building value is in loan, could be subject to tax. So let's say that building generated a profit of $40,000 for the year. That would mean that, in theory, $20,000 of that income was really gained from the bank's money. So the IRS is going to want to have you file what's called a 990T tax return. If your accountant is not familiar with that, there are many accountants who are, and I would suggest that you do seek out a competent tax person who is very comfortable in doing 990T tax returns and doing tax work for IRAs and retirement plans, because it is a different tax return. I don't want to scare you off because, quite frankly, most of the time on the tax returns that I've seen, on paper, the property does not make money because you can take your typical deductions for taxes and insurance, operating expenses, and depreciation. And those of you who invest in real estate personally, you know that that's a powerful tool, and your depreciation will typically offset almost any income you make. So UBIT is not an onerous tax, but it's one you ought to be aware of and I would suggest that you talk to a tax professional about it as you're exploring your investment and the idea of putting some leverage on it. Properties we lend on. We will lend coast to coast, all 50 states, on basically any kind of income-producing property. And so it could be residential, single families, townhomes, condos, vacation properties potentially. We will lend on those. And if the property has never been a rental before, and most of the time they haven't been, the kinds of properties I see investors bringing to me to make loans on were picked up at foreclosure prices, or they've been just owned by the person living in the home. They've never been a rental before. So how do I look at that? I just have you, the investor, produce a pro forma income and expense analysis on what you believe that that property will do. So just because it hasn't been a rental property before, I would have you produce a pro forma P&L similar to that, the debt service example I showed, and you'd list your expected income minus all your anticipated expenses, and that should produce at least that 1.25 debt service coverage or better. So whether it's an apartment, it's a multifamily, each kind of property will still and should still produce that debt service coverage. And you as the investor, it's up to you on what kind of return you want and are satisfied with. So you drive that deal. Commercial properties will lend on a Dollar General land lease, for example. Folks have bought Dollar Generals and Family Dollar stores, and then they have a national tenant, pays them a triple net lease. It turns out to be an awesome investment for a lot of folks. Other kinds of commercial buildings, commercial offices, commercial condos, office warehouse. I've done a lot of lending on those kinds of properties. So anything commercial. I don't do motels or bars, but other than that, we'll lend on pretty much any other cash flowing commercial property. And lastly, we will lend on farms. You know, you may, if you're familiar with agriculture, have a prime piece of ag land you have an eye on, and the farmer who is farming it now or the farmer who lives next door wants to continue to farm that. You get a lease from that person on that farm ground, and I'll lend on a farm with income. So you can see the palette of properties we lend on is very broad. We'll lend on almost any kind of investment property coast to coast, all 50 states. We've been doing this for about 6 years nationally. We closed our first loan in April of '08, and we've continuously grown the business since, and we're one of the, if not the leading non-recourse lender in the country. We lend in all 50 states, and we're here to help and finance that next purchase. So my name is Roger St. Pierre, and I know Jared may have some questions that you folks have fielded throughout the presentation, and if you have those, I would ask you to field them now. We're here. We have a very good website, just so you know. It's at myiralender.com, and I'm Roger St. Pierre, and feel free to pick up the phone and call me. We also have a blog and a learning center, and we will be also coordinating with Next Generation to put this learning piece and webinar on our website too under the Learning Center, so that you folks out there can refer to it at a later date. Jared, do you have any questions that folks have in queue, or maybe that you have thought of as I've gone through the presentation that would be you'd like to put at me?
Well, thank you so much, Roger, first of all. But we do have a couple that have come in. We do have a few that I think some people have a couple of good questions. First, do you want to hand out your contact number just to get everyone?
Yes. My phone number and the phone number for the bank is 800-908-8845. And again, that's 800-908-8845. And our website is www.myiralender.com. So you can see us on the web, and there's the phone number. You can call me. My email as well is roger@myiralender.com, and feel free to email me if you have a question or a possible property you want to run by me. Don't hesitate to ask. We can
Certainly.
also write pre-approval letters, and that's a helpful tool in a lot of markets. And we don't need to go through a whole loan process to do a pre-approval letter. If someone is wanting to put an offer in on a property, and the common practice in that market is to know they're pre-approved, we can do that. So keep that in mind. It's an assist to help you folks get that property under contract, so then you can take it to the next step.
Wonderful. Thank you again, Roger. The first question that has come in, do you run a credit check on the individual? So I know you mentioned a few things that you don't lend on regarding the personal individual, but do you run a credit check on them?
Yes, we do. And that's the only piece of personal credit or financial data, quite frankly, that we do look at. And the reason why I do that, or we do that as a bank, is that we view how somebody pays their personal bills as an indication of how they will probably direct their IRA or self-directed retirement plan to pay its bills. So I do pull a credit bureau, but we do not look at personal tax returns. I don't look at personal financial statements, but I will pull a credit bureau, and that is really the last thing that I do on a loan request. So you know, if the property meets all the other due diligence and everything else lines up and cash flow is good, only then will I pull a bureau. If the property does not meet our template or our approval going in, then I'm not going to bother to pull credit and put a credit on your credit bureau. So just so you know that. But yes, we do pull credit.
Okay. The next one I have, so do you have a, I guess the question is, do you have a team that sort of analyzes the deal, and what's the turnaround time of the, I guess, analyzation process?
Sure. Good question. We have two underwriters at the bank here. I am one of them, and the president of the bank is the other underwriter here. We both are available to underwrite and review deals, and our turnaround time is quick. On an average deal that you send to us that's complete with the other documents we want to see, normally we can give you an answer within 2 business days. So normally a deal that landed on my desk today on Tuesday, I would have an answer to the client by Thursday, and it costs nothing to apply. Only if we like your deal, then we'll give you and quote you terms on it, and then ask you to send us appraisal deposit and move it to the next step in processing. Normally we're going to close in about 30 to 35 days, start to finish. So it's quick. 2 days for a loan decision and 30, 35 days to close. And we will close at whatever title company or closing agent that you prefer or your realtor prefers. So it's your choice, and we send loan docs to the closing table in every city in America, wherever it's happening, and we'll send the loan docs there and you sign up. I guess one thing I would mention about the closing is this that differs slightly from a personal closing, and that is that since you're not the borrower, your plan is you're merely going to initial the documents as read and approved. You're not actually going to sign as the borrower. So at the closing table, you will review all the documents, initial as read and approved, and then those documents will be sent to Next Generation Trust. They will review them, sign off as the borrower, send them back to title company, and then the deal can fund. So be aware that there will be probably a 2 to 3 day process in actually closing and funding, because those docs do need to go over to Jared's company to review and sign. Okay?
Absolutely. Now, do you ever close, or do you ever loan on less than 45 to 50%? Because this individual has heard upwards of 35%. Is that something you're willing to, is that doable, 35%.
You mean like a 35% down payment?
Yes.
You know, I haven't gone to that extent of leverage, Jared. 60% really is our maximum, so that would require a 40% down payment. One thing that does come to mind, we can do cash out refinances, though. There are many of you who maybe already own properties in your IRAs or self-directed plans, and you paid for them with cash. Sometimes that's the best way to get the best deal or a short close. You buy it with cash, then you can come back to us later and do a cash out refinance. And the terms are the same, the process is the same, the cost is the same to you, so keep in mind we can do cash out refis as well as purchase money loans.
Do you lend on residential commercial mixed properties?
You know, that is the one type of property I don't lend on, Jared, and here's why. Everybody needs a house or a place to live. So it's fairly easy to finance residential properties and get them financed. Not everybody needs a commercial property, can't live in them. So we view those kinds of properties as it's a mixed use, and it's hard to finance in the secondary market or other lenders. And if we would have a hard time selling that property and the subsequent borrower getting financing on it if we ever had to take it back, if we're going to have difficulty selling it, then I would prefer not to make a loan on it in the first place. And mixed-use properties are pretty hard to get financed out there. Not everybody needs a commercial building, and commercial building people don't necessarily need a bunch of apartments. So no is the short answer, but I'll lend on any kind of other residential property or commercial property as long as it's not a mix.
Understood.
Okay.
Let's give one more minute to see if there are any other questions.
Rates are very good now, just so you know. They're in the 4s, which is pretty awesome. And we do have both adjustable rate and fixed rate products, and we offer long-term amortizations out to 25 years with no prepay penalties. So it's pretty easy to get pretty good cash flow on a lot of deals if you have nice long 25-year amortization. So bear that in mind. Our loans don't have prepayment penalties. You can always pay off early or pay more on principal, and rates are excellent. So we can discuss and call me for those if you have a project that you have in mind. And like our slide shows, we lend in all states. There's some parts of the country that cash flow better than others, but it's up to the investor to pick the investment in the part of the country that works for them. But we'll finance in any state.
All right, and as Roger mentioned before, we're going to be up. This presentation is going to be up on the First Western Federal Savings Bank website as well as the Next Generation Trust Services website. Oh, it looks like we got one more that came in. On the follow-up with the mixed-use building is 3 residential and 2 office and 6 storage units. Would you still not loan on that?
I wouldn't loan on it because it has residential and commercial components together. All commercial good, like for example office and a storage unit, that's a probable good. But when you start throwing in the residential components, it's not something I'd do.
Would you loan to 2 individual IRAs that are partnering together?
Good question, and the answer is yes, and that's a good point. We can lend to 2 IRAs that are partnering. Maybe they're going 50-50 partners in a building, or maybe one's a 40-60. We can do that. We also do a lot of lending to multi-member LLCs. So perhaps somebody has a account with Next Generation Trust. They have another person with the same. They prefer to use an LLC structure. Their IRAs can each be members in that LLC, and then it makes a real clean deal. The lender is a bank. We can just lend right to the LLC, and the LLC is the owner and the borrower. Anyway, that's a good way for multi-investors to get together and pool their funds. is either through an LLC or just a couple of you folks out there want to use your next generation trust IRAs and as your entity, we can lend to you. So you bet. We'll do multi-member deals or multi-IRAs on the same loan. Yep.
All right, wonderful. I think we're going to wrap it up at this point. Roger St. Pierre, Senior Vice President of First Western Federal Savings Bank, I want to thank you so much for coming and presenting that terrific information today. Again, my name is Jared Lopez at Next Generation Trust Services. If you have any questions, you can email me at info@nextgenerationtrust.com, or you can call the office 973-533-1880. Roger, do you want to give your number out one more time?
Yep, and it is 1-800-908-8845. And again, I really want to thank you, Jared, and Next Generation Trust for offering me the opportunity to help tell a little more about non-recourse loans. They're not difficult to get. It's a very straightforward process, and again, I'm happy to have had the opportunity to speak, and I wish you all the best. And again, thanks, Jared. Appreciate it.
Thank you. Have a great night.
You too. Bye-bye.